Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on should investors chase IPOs or wait for the dust to settle? And so before we jump in, I thought we would start on what is an IPO. So an IPO is an initial public offering. And basically what this does is when a company decides to go through an IPO, their common reasons are they're wanting to raise capital for future growth and the potential for liquidity for some of the existing shareholders. And so there's a process behind the scene that takes place when you have IPOs that come out. And recently there's been a lot of headlines and a lot of excitement and just, but there's definitely a process and things to consider. And so one of the things investors should review if they are even considering an IPO is looking at the prospectus, looking at the company financials, its valuation. And so there's a lot of other information to consider, and we'll kind of dig into that a little bit today. So I guess the thought is, sometimes investors feel like, am I missing out, or what is this, and should I be involved? And so right when a company goes public, there are sometimes some of the IPOs go up, they soar, and sometimes they go down. And so there isn't a magic wand that says, okay, it's definitely going to go up every single time. And so you can experience some volatility along the way. So today we're going to talk a little bit about, whether, some of the things you should consider when you're evaluating the IPOs.
So the first part we're going to talk about is why IPOs create so much excitement.
Yeah.
So one reason that initial public offerings or IPOs generate so much attention is because investors naturally, they want access to successful companies early. And of course, there's that FOMO, the fear of missing out, like you just mentioned. When a company's been private for years and appears to be growing really rapidly, investors really feel that they've missed out on much of that company's journey already. And then suddenly the opportunity is available. And the media, of course, is covering it. And it's all over social media. And everybody's excited. And everybody wants to know, okay, should I get in? Should I not? And there's a lot of psychology behind all of this. And you have to remember that, people remember the big IPOs. Yeah. They don't necessarily remember the ones that don't go as well.
Somehow they block that out, right?
Exactly. So they remember that, the investors that bought early made a lot of money, and but they don't know about the ones that bought in early and lost a lot of money. Yeah. So you definitely want to do your due diligence and your homework. And really, there's a really powerful narrative out there, especially online and the news. Investors really feel like they have to act quickly. But successful investing, you really have to think about being disciplined and following a plan.
So I guess one of the common questions we hear is, should I buy on the first day?
Got that
and
a lot.
So and so the question is, well, it depends. And so many investors assume that the first day is the greatest opportunity, but the pricing of IPOs get a little complicated. So behind the scenes, pre-IPO, there are underwriters. There are some financial institutions that get access to shares. And typically behind the scenes, for pre-IPO, there are conditional offers to buy shares. And when you put those in, it doesn't mean you're actually going to get the shares, but you may get access if there's some, once it gets allocated. And so if you did put in for the IPO and you did not get shares, then you have to consider, okay, people ask, should I buy on the first day? So usually what we see on that first day, there could be some market volatility. It could go up, it could go down, and within usually the first several days, several weeks, and several months, we see some of these prices fluctuate. And so once again, while you may want long-term to have access, you have to consider, okay, when's a good time to get in? And once again, it's really, you can't really time this. And so if you can be patient and kind of look at, is it a good idea? And are you willing to handle that volatility in the beginning? Because if you lose money, you don't want to lose money if you can. You would want to try and make money is the whole idea. And so once again, learning about the company, the market value, and how IPOs work is important. And typically, institutional investors that get access to the IPOs before they start trading sometimes some of these investors or even retail investors that get access, they have to hold, if they get it pre-IPO, have to hold the position for a certain period of time. And so once again, that could change some of the volatility of that position. So once again, it's, this is definitely something we want to have conversations with each individual investor on.
So another question that we get often is why do many successful companies experience volatility after going public? And so this is a kind of something interesting that happens. The company itself might be excellent, but the stock still could struggle, and it's because expectations matter. And so when the company goes public, investors often have built these optimistic assumptions into the price, and then reality happens, and quarterly earnings reports begin, and growth rates become easier to evaluate, and the competition becomes clearer, and management teams, because it's now a public company, face scrutiny. And in addition to that, many IPOs have lockup periods that eventually expire. And when that happens, early investors and employees gain the ability to sell their shares. And that additional supply can create downward pressure on stock prices. So none of this necessarily means the business is failing. It simply means the market's trying to determine what the company is actually worth.
Yep. So let's kind of take a step back and look at kind of the history of some IPOs. So
history can teach us stuff.
Yes. So many companies come out, and obviously you look at it as a long-term investment, but then potentially they could experience a decline when they start trading. And so sometimes what we find is if you didn't get in before the IPO and you wait, it gives you a chance to gain information, see how the company does, are there better pricing opportunities. And so while, yes, there's the excitement and you may want to jump in right away, being patient can also be powerful. And once again, we're not here to jump in and out of the markets, and so this is really designed for only specific clients that are really looking for these types of strategies, investments, because there's a lot behind the scenes that we also look at overall for investments for our clients.
So let's talk a little bit about history. I looked up some statistics,
let's hear.
And I thought it was interesting. So the University of Florida, they came out with some statistics, and they said that in 2025, there were 90 operating companies went public in the U.S., which I thought was interesting. And then according to Bloomberg Law News, over the past 2 decades, the IPO market has transitioned to an era of fewer, older, and larger companies. And the market peaked with an all-time record of 1,035 IPOs in 2021 before cooling significantly due to macroeconomic tightening, it says. So I thought that was kind of interesting that 1,000, I mean, this in 2025, only 90 operating companies went public, whereas in 2021, 1,035 did.
Yeah, that's a big difference.
I thought that was a huge difference. So the next question that investors should be asking before buying an initial public offering, there's a lot of questions. First, do I really understand the business? You really need to understand what you're investing in. Is the company making money? What competitive advantages does it have? And then the second question you want to be asking is the valuation reasonable? Because even exceptional companies can be risky if people's expectations are too high. And then a third question that you want to be asking yourself is, does this investment actually fit my overall financial plan? We're huge, advocates for having a financial plan. So do you have a plan, or are you just reacting and are you getting excited with everybody else? So
I guess one of the biggest misconception is that investing, you have to be first and I have to get in. In reality, being patient, consistent, and disciplined with your approach and really evaluating, is this a company that you want to invest in? So once again, the goal is to build a portfolio that supports your long-term financial goals. And like you mentioned, we look at the plan, we figure out what type of investment strategies go along with the plan and help our clients invest. And so potentially maybe these positions might get added into our portfolios later, but we're not big on kind of riding that roller coaster ride along the way.
Yeah, because it could be very, very volatile after the initial public offering. And are you willing to, how would you feel if the stock went down 30%?
Yeah, and it shouldn't feel like a competition. I mean, this is a process. Let's just
And does it fit into your plan?
Yeah, exactly. So although I think a lot of it has to do with the hype and the excitement that's out there in the media.
So the real goal is not really winning on the first day. And one of the, the biggest misconceptions in investing is that success comes from being first. But like you said, Catherine, wealth is built from patience, consistency, and being really disciplined with your decision making. And your goal isn't to win. Mm-hmm. The goal is to do what's right for you and for your financial strategy and your long-term financial goals. So if you miss a few weeks right after an IPO, it might not be the biggest loss. Yeah. Actually could be the right decision.
It might be in your favor.
It might be in your favor,
Yes.
Exactly. And investing, like you said, shouldn't be a competition. It should just feel right for you.
Yeah. And once again, we're not saying that, sometimes it does, if you do want to have that excitement and want to participate right away, that might be right for you. So obviously it's just seeing, how much you're looking at and how does it tie in, because successful investing isn't about owning a very exciting company. It's about having a long-term plan and strategy along the way and being thoughtful with some of the decisions and how your money is working for you. And so I know we covered a lot on the IPOs today. It's been, out in the media everywhere, so we thought we would touch on that a little bit. If you would like us to discuss your overall financial plan or your investments and strategies, or if you have an interest in talking about how IPOs may or may not fit for you, we'd be happy to have a conversation with you. And you can reach us at 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.